Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at three top-ranked Zacks stocks to consider buying for both growth and upside, who have managed to up their earnings estimates amid all of the economic slowdown worries and inflation fears. And the three stocks we're looking at today are Pure Storage, Chef's Warehouse, and Ulta Beauty. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. And also, before we jump into these actual three stocks we're talking about today, it's worth just going over quickly what's going on with the market and the Fed and interest rates to give a sense of why we're looking at these three stocks and where the market might be headed in the near term. So the Fed remains on that warpath against inflation, with Wall Street currently betting on a third consecutive 75 basis point rate hike at its next policy meeting, which is on September 20th and 21st. So Powell and the Fed view tackling inflation as their number one priority and are really willing to cause pain when it comes to jobs and economic growth, if that's what it takes to bring down prices and cool 40-year high inflation. The Fed's task, though, is far from easy, since there's an array of factors fueling higher costs, many of which are out of their control. All of this is leading some Fed officials to call for the Fed funds rate to be lifted to roughly 4% by the end of the year. This would require another roughly 1.5% hike from the current levels, which it could achieve through various hikes starting in September. Specific targets aside, though, Wall Street's slowly starting to reverse its peak inflation bet that helped the market climb off those mid-June lows. And rightfully so, since the U.S. labor market remains strong and employers are still struggling to hire workers, which is driving up wages and therefore inflation. So stubbornly high inflation also has obviously a wide range of impacts on consumers, companies, corporate earnings, interest rates, and beyond, which is the reason why we're seeing so much downward earnings pressure for Q3 and beyond, which is why we're going to be talking about these three stocks we are today as part of the reason. And obviously, the hawkish Fed is helping drive U.S. Treasuries back up. So we're 10-year sitting about 3.3%, which is up well from its where it was recently, but still a little bit below those fresh decade-long highs of 3.5% that it hit in the middle of June. And then we're seeing these higher rates in the hawkish Fed really work their way across the many aspects of the market. We saw mortgage rates hit their highest level in 14 years this week, all the way up to about 5.89%, so about 5.9%. In this time last year, rates were at 3%. So that's how quickly everything's changing. And then we saw Thursday, the European Central Bank said it would raise its key interest rate by 75 basis points, which is a really big hike for the ECB. And this now takes its key rate to 0.75% from zero, which is its second hike this year. So despite all of these broader stock market worries and economic fears and all of the turmoil that's coming with this high inflation and the prospect of cooling economic growth, we have seen people still pour money into U.S. equities because the U.S. economy is comparatively strong, and obviously staying in cash comes with that 8% charge at the moment. So with this backdrop, we're going to take a look at three stocks, as I said, that have managed to up their guidance in the face of all the negative economic forces and have high Zacks ranks with some solid growth upside. And the first of those three stocks we're going to look at today is Pure Storage, which trades in the ticker PSTG. So Pure Storage aims to deliver the most advanced data storage technology and services by offering what it calls storage as a service, which is helping businesses store their data seamlessly across multiple cloud platforms. Pure Storage has expanded its customer base, within the business world by helping its clients put their data to use while also reducing the complexity and expense of managing these infrastructures. And the enterprise cloud storage hardware and services company is set to continue to grow just as demand for cloud-based storage keeps expanding. We live in a world of pretty much infinite data, so Pure Storage and other cloud storage businesses are going to continue to boom for years and years to come. Pure Storage topped our Q2 estimates at the start of September and raised its outlook as customers, as the company said, struggle with their ability to manage their exploding volumes of data, and they're continuing to look for Pure continuing to look to Pure Storage for those simple automated solutions. Companies just want the ability to have things go smoothly, and Pure Storage has been able to offer pretty solid solutions for that. So we've seen the company update its bottom line outlook since then, and we've seen analysts then race to update their estimates. So the company's bottom line positivity is helping it land as Zacks ranked number one strong buy at the moment. And so we've seen its estimates climb since that report, and then its most accurate estimates, which are those most recent analyst estimates we have, are up way above the current consensus estimates. So we could see some big bottom line positivity from Pure Storage going forward. And the company also has a really impressive surprise over the last 4 quarters. It beat by 45% recently. It beat by 500% the quarter before that. So it's averaged about 171% average bottom line surprise in the trailing 4 quarters. And then in terms of the actual growth numbers, Zacks estimates are calling for 26% top line growth this year to get to about 2.8 billion, and then another 15% growth in 2024, which big 26% growth this year, and then obviously 15% growth would be impressive and come in well above the inflation rate. And then on the bottom line, we're calling for about 40% growth this year, and then another 20% growth next year. But as I said, those are based on our consensus estimates, which are set to rise as the most accurate estimates are coming in well above, which then is going to probably send these consensus estimates even higher. Overall, Pure Storage stock is up about 66% in the last 3 years to outpace the computer and technology market, which is up about 42% over this stretch. And despite this climb, Pure Storage's average Zacks consensus price target marks 32% upside to its current level, so some big upside. And overall, Wall Street's pretty high in the stock. We have out of the 17 brokerage recommendations that Zacks has for the stock, 13 are coming in at strong buys with nothing coming in below a hold. And on top of that, which is always a good sign, its computer storage devices industry is in the top 9% of over 250 Zacks industries at the moment. So certainly worth considering as both a near and longer term play. And now we're going to move on to a totally different sector of the economy that's also been able to succeed and thrive amid these inflation and economic slowdown fears, and that is the Chef's Warehouse, which trades under the ticker CHEF. So Chef's Warehouse is a top distributor of specialty food products in the U.S. and Canada with a focus on the higher end side of the dining scene. So the firm aims to serve, quote, chefs who own and operate some of the nation's leading menu-driven independent restaurants, fine dining establishments, country clubs, hotels, and beyond. The company carries and distributes over 50,000 products to more than 35,000 customer locations. And its business the company topped Q2 estimates, in late July and raised its guidance once again, which it also did back in the first quarter on the back of strong away from home dining, despite growing economic slowdown fears. And it's worth noting, since the Chef's Warehouse is serving this higher end dining space, those consumers and higher income spenders are continuing to spend despite inflation worries, which is why kind of inflation is going to probably remain an issue as people are just not even noticing some of these price gains and are continuing to go out and live their lives, especially after many people were hampered from doing so with COVID lockdowns, and just things are getting back to complete normal for most people, and going out to eat could be a big part of that. And there's also still plenty of room for growth, since the hospitality and event space is still not back to its pre-pandemic levels yet. So that's good sign for Chef's Warehouse that they're able to continue to grow on top of that. So we're calling for about 41% top line growth this year to get all the way up to about 2.5 billion, and then another 10% growth in 2023. And then we're calling for the company to swing from an adjusted loss of about 5 cents per share last year amid what was lingering COVID lockdown and different isolation fears, where restaurants just weren't really back in business at full capacity last year, all the way up to $1.36 per share in earnings this year, and then climb another roughly 16% next year. And like with Pure Storage, the company has really been able to crush our bottom line estimates over the trailing 4 quarters, including a 46% beat in Q2. So overall, the stock has soared off those COVID lows. Obviously, it fell significantly as people locked down and there was not going to be a lot of people eating at restaurants. So the stock's up 100% in the last 2 years, and it's up 20% in the past 12 months. This is part of a larger 100% climb over the past decade, which outpaces its broader consumer staples sector's 81% jump. And it's now trading near 2-year-long lows in terms of its valuation. So it's trading at about 22.3 times forward earnings, which is also right around its 10-year median, which is really impressive considering its rather large jump in terms of its stock price performance over that. And we should also note that its average Zacks consensus price target marks a 35% upside to its current level. So some big growth upside there as well. And 4 of the 6 brokerage recommendations that Zacks has are strong buys, with 1 more buy and 1 hold. So Wall Street's pretty positive on the stock. And then also its bottom line revisions help it land a Zacks rank #1 strong buy. And Chef's Warehouse operates a rather resilient business, as I said, especially as people continue to go out to eat and its fine dining customers are booming again. And really the only thing that was able to stop it over the last several years were those COVID lockdowns, which hopefully won't happen again anytime soon. And now we're going to close out with another company in another stock that's really been on Wall Street, the top of Wall Street's mind recently, and that is Ulta Beauty, which trades on the ticker that it's its name, Ulta, ULTA. So Ulta Beauty began to reshape the broader beauty retail space back in the early 1990s by bringing everything under one roof, so just different sectors of that beauty economy. So today, its rather larger format stores sell cosmetics, fragrances, skincare, hair care, salon services, and more. Ulta sells an array of brands as well, so from higher-end price points to its own in-store brands. The company operates roughly 1,300 retail locations across all 50 states, and its brick and mortar footprint is growing rather significantly. They're continuing to open stores, and also its e-commerce segment is also obviously gaining traction as well. And Ulta's ability to expand that footprint is helping, and just people are continuing to spend money on cosmetics. So it's posted double-digit revenue growth every year since its public debut in 2007, outside of obviously those pandemic lockdowns when shoppers had far fewer reasons to get dressed up. So Ulta posted at one point a stretch of 8 years in a row of 20% or higher revenue growth, and it's also bounced back in a huge way already off that COVID slip, and it's coming off a big second quarter with revenue up another 17% and adjusted earnings up 25%. More importantly, the company raised its guidance once again as it sees strong trends in the beauty space despite slowing consumer spending overall and inflation headwinds. Analysts raced to update their EPS estimates following that beat and raise quarter on August 25th. That helps it land a Zacks ranked #1 strong buy at the moment. And like all 3 of these stocks, or like all 2 of the other ones we've already talked about, it's been able to easily beat bottom line over the last 4 quarters as well. In terms of what our outlook is for the near term, Zacks estimates are calling for its revenue to climb 14% in 2022, and then another nearly 8% higher in 2023. And its adjusted earnings are set to climb 18% this year, and then another 10% in 2023. And both of its FY 2022 and 2023 consensus estimates could move higher as more analyst estimates come in. And Ulta stock's also been bucking the market's downturn so far this year, with its shares up around 8%, including a recent surge to new highs that actually hit brand new highs on Thursday. Yet it's still trading 10% below its current Zacks consensus price target, so that's a great sign. And obviously, the stock's also been on a longer run. The stock's up 90% over the last 2 years to blow away the market and its econ sector. And the stock's up about 340% over the last decade. So really been a strong performer recently and over the long haul. And on the valuation front, it's trading at a discount to the wider retail space. Despite that outperformance, it's trading at 19 times forward earnings versus its industry's 22.6 times average. And it's also trading at a 50% discount to its own highs, despite its own 10-year highs, despite this long run and outperformance. And it also is trading at roughly 30% value compared to its median during that stretch. So solid value as well. The company's also set to repurchase nearly $1 billion, $900 million worth of its own shares in 2022. It's able to do that through a sturdy balance sheet and a strong management team. And once again, it's just worth noting that the beauty industry is booming and it shows no signs of stopping in a world dominated by staying on trend and social media. And obviously those are just kind of newer pushes. This has always been a big business. And it's been able to remain strong in the face of slowing consumer spending because shoppers aren't cutting back on its offerings. This is part of those higher income shoppers as well. And it's also worth remembering that there's even an established phenomenon known as the lipstick effect that showcases a willingness to buy smaller ticket items and quote unquote like fun things, little splurges when people can't buy those big ticket items amid economic slowdown fears. And obviously, it's been no easy task to stay above that selling in 2022, especially hit new highs. And Wall Street's obviously very high in the stock, considering all of that we've just talked about, with 17 of the 21 brokerage recommendations that Zacks has coming in at strong buys, with nothing below a hold. So all three of these stocks certainly look worth considering for the back half of 2022 and as possibly longer term plays within very different areas of the economy. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.